Good evening and welcome to our discussions on frequently asked questions in accounting. And today's question is about depreciation. How is depreciation shown in the financial statements? But before we see the effect of the depreciation on the financial statement, let me briefly explain depreciation. Depreciation is a reduction in the value of the depreciable asset. All assets are not depreciable. For example, the land is not depreciable. Generally, the property, plant and equipment are said to be depreciable assets. So the value of these assets keep on reducing over a period of time, and that reduction is called depreciation. The depreciation can be calculated on the original cost, or depreciation can be calculated on the original cost minus depreciation, which is called the book value. The difference between the methods of depreciation calculation we'll pick up in the next discussion. But in this session, we just want to understand how will depreciation appear in the financial statement. In the income statement, it is shown as an expense. In the balance sheet, depreciable asset is reduced to the extent of depreciation, and the cash flow, there is no effect for depreciation. Let us take an example to understand that. So we have this opening balance sheet with the assets and corresponding sources, and we have only two transactions: sold stock and purchase plant. So sales is 60% is sold for 150,000, and let us assume that entire sales is for cash, so therefore it also cash flow. But whenever there is a sales, there has to be cost of goods sold, and the cost of goods sold is 0.60, and the stock will reduce to the extent of the goods sold. When you purchase plant, and the plant purchase is a payment, and the value of the plant will be shown on the asset side, and the reduction of cash. So plant on the date of acquisition is a asset on the balance sheet. And then we say that depreciation, suppose depreciation is 20%. If depreciation is 20%, depreciation will be calculated on the plant and assuming that the asset has been purchased at the beginning of the year, so the value of the plant will reduce to the extent of depreciation, which is 10,000 here. Let me show that once again. So the value of the asset reduced from 50,000 to 40,000 because of depreciation. Since no other items are there, the total expenses is 100,000. So PBT, profit before tax, is 50,000. As usual, assuming the tax rate to be 30%, and assuming that we paid the tax fully, so therefore profit after tax is 50,000 minus 15,000, that is 35,000. If no information given, entire profit will be added to the reserves, entire profit, and the cash in hand will be inflow plus the opening cash. The cash outflows are the plant purchase and the tax. So the 65,000 is a cash outflow. As a result, the cash in hand is 250,000 minus 65,000, and that is the asset 285. No change in the capital, no change in the loan, so the balance sheet tallies. But the focus of our discussion was depreciation. The depreciation is shown as an expense in the income statement, and depreciation will be reduced from the value of the plant. So depreciation is reduction in the value of the asset, and the reduction is shown in the income statement as an expense. So going back to here, so in the income statement it is shown as an expense. In the balance sheet, the depreciable asset is reduced to the extent of depreciation, and in the cash flow, no effect. We can see that in the cash flow there is no effect on the depreciation. Thank you very much.